Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Last week's calm interest rates gave way to a flurry of economic data in the first week of April, with several major monthly reports being released. Among these were the Institute for Supply Management's report, including the highly anticipated employment situation, commonly known as the jobs report. The majority of the week's data was good for bonds and rates, as it was weaker than expected. Bonds benefit from weak data as a slower economy is less capable of sustaining growth and inflation. Two key factors that influence interest rates. The ISM Purchasing Managers Indices, PMIs, are the main barometers of growth in the corresponding sectors, with anything over 50 indicating growth and anything under 50 indicating contraction. The first half of the week had some positive news for interest rates. The Job Openings and Labor Turnover Survey, also known as JOLTS, released data that showed a significant decrease in job openings in February. Although the numbers are still high, the trend is what's important. Combined with the ISM data, JOLTS contributes to the idea that the consistently strong economic momentum is starting to slow down. JOLTS wasn't the main labor market indicator of the week. The big jobs report was more important, and it had some positive news. Job creation was as expected, wage growth remained steady, unemployment dropped to 3.5%, and the labor force grew to its largest size since March 2020. A chart of the unemployment rate shows a strong labor market, so it's difficult to argue that there is weakness. The bond market reversed its progress after the jobs report, which contradicted the trend seen in the previous week. The momentum towards lower rates stalled by Wednesday morning, suggesting that traders already believed significant progress had been made. After the jobs report, there was a significant change in Fed rate hike expectations, and the market quickly priced in the possibility of a rate hike later this year. Earlier, the market had completely ruled out the chance of any rate hike by the Fed in 2023. Mortgage rates typically follow the bond market, though the extent may differ. The average lender offered the lowest 30-year fixed rates since early February on Thursday. However, on Friday, rates rose along with the rest of the bond market. Fortunately, the increase in mortgage rates was not as significant as it was for other bond market components. Looking at the bigger picture, the rates for mortgages and 10-year Treasury yields have been fluctuating between 6 to 7% and 3.3 to 3.8% respectively, as the market is waiting for clarity on growth and inflation. While this week's data only caused a small amount of volatility within this range, it may take consistent messaging from economic data over the next few months to settle the debate. However, the Consumer Price Index report, which will be released this week, could have a significant impact on rates. If the core inflation of March is higher than expected, rates may rise again. But if inflation is shifting into a calmer gear, rates may break below the current range. The CPI report holds as much weight as the big jobs report these days and may help determine the market's next move. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.